So when does the LP's capital account usually go negative? 4% deals, because you have fewer credits for the investor to buy, and therefore the investor is going to contribute less equity. I could have a $10 million building on a 9% deal and a $10 million building on a 4% deal, and my equity would be remarkably lower, potentially as low as, say, a third of the amount that it was on the 9% deal, because it's a 4% deal. That's a very dramatic difference in terms of just a starting point, which means if I'm starting that much lower, it's that much quicker for me to get to zero and head negative. So 9's big, 4's small. All right, everybody understands that math. All right, next, let's say I have a low credit price. If my investor is paying 95 cents, they're going to have a lot more equity in the deal as opposed to paying 65 cents. I think in recent years we've even seen some deals into the 50s in terms of credit pricing. If your credit pricing is that low, that usually means that your LP's capital account is starting that much lower. And if we're combining these, a 4% deal with really low pricing, then I'm really hurting in terms of starting point on my capital account. What else tends to drive a capital account negative? If I have an underperforming asset where maybe I'm not even getting to break even, my costs have spiked, maybe my insurance is way up, and my repairs and maintenance are coming in way higher than I expected, and my vacancies, I was expecting 5%, but it turns out that a new project just moved in down the road, and my vacancy spiked to 20%, and all of a sudden, on a cash basis, I'm losing lots of money, which means that I'm also generating more taxable losses than what I was really expecting. And a good way to know that I'm going to have a problem here is if my general partner is funding operating deficits. That's usually a hallmark of a deal that's underperforming, is I've got GP deficits that are being funded every year. And if GP deficits are being funded, that's probably because I'm not making any money. In fact, I'm losing money. So my losses just got a heck of a lot bigger, which means my capital account gets small in a hurry. The other thing to think about is I might have other non-cash deductions. From an accountant's point of view, if I'm debiting an expense and I'm crediting something other than cash, that means it's a non-cash deduction. And in a lot of cases for partnerships, especially in an affordable housing context, you may have accrued fees that are owed to maybe a general partner or even a limited partner, and those can sometimes be large. They can sometimes be very large, especially over a 15-year period. And those deductions generate additional losses, and since you're not paying for those currently, you're not generating enough income to actually pay for those, that's helping to increase the size of your losses. You also see a lot of deals where you have interest that's not due currently, especially on a lot of soft debt, or maybe debt that's owed to a partner, where they loan the money in and the payments are owed out of cash flow. And if the project doesn't generate enough cash flow to actually pay those debts, then I'm taking deductions and accruing a liability for that interest, which that deduction reduces that capital account. It bumps up my losses, but it doesn't mean that I'm losing more money on a cash basis. If I'm heading negative, that's a problem. What are some strategies to keep it positive?